The big real estate short is heading to offices. And you can absolutely bet for certain, money in the bank, that this will eventually trickle down and impact the housing market. If you're new to the channel, welcome aboard. My name is Chris Igoe. If you're a returning viewer, I appreciate your participation in our journey. Today, I'm going to share some breaking news that you might not be focused in on. You might not think has much of an impact on the residential housing market, but I suspect it's proof positive of what is yet to come because these commercial backed mortgage securities that are getting whacked are absolutely a leading indicator as to what will happen in the future. Now, I've talked a lot in the past about what I expect the pain of recession to be. And having been a stockbroker for 18 years, I've seen major institutions fail. I've seen total sectors fail. I've seen the financial sector get absolutely decimated and be on the brink of complete insolvency. And if the government hadn't stepped in and taken the actions that they did, that absolutely would have happened. But we're starting to see it in real time. And so I want to share this content with you so that you can make the best decisions for yourself, for your family, and for your financial bottom line. And I want to send a shout out to the Real Estate Ninja who covered some of this topic yesterday. So you should absolutely check out his channel. But today I'm going to do a deep dive into some more current news so that you know exactly what's going on. And if you find this content valuable, please subscribe to the channel. This will be unedited. I want to get this out to you as quickly as possible to provide the most value. All right, so here we go. Now, this is a Bloomberg article. I will link it in the description down below if you want to check it out. And what it goes on to say is that Brookfield defaults on two Los Angeles office towers. And the properties include the Gas Company Tower and the 777 Tower, not to be confused with the 666 Tower, which is not a good place to be. Brookfield DTLA Fund has warned it may face foreclosures. Well, that's no bueno, right? This came out February 14th. The Brookfield Company, parent of the largest office landlord in downtown Los Angeles, is defaulting on loans tied to two buildings rather than refinancing the debt as demand for space weakens in the center of the second largest U.S. city. A loan default is no bueno. And I've talked about this in the past. In fact, I will link a video that I did back in November talking about the liquidity crisis that is sure to be felt at some point. Well, that some point is now because many of these funds, many of these big corporations, many of this institutional money, which has to refinance at higher rates, is now getting squeezed. The explosion of interest rates has a direct impact on the corporate debt of these companies. And they are feeling the pain right now, well before the consumer feels it. But make no mistake, the pain of recession is coming. And to put that in perspective, housing market, real estate values locally are going to be set on the fringe minorities of pricing. And here's what I mean by that. Your home's value is going to be set by your neighbor's most recent sale. And during the financial crisis, there were 18 million distressed sales. Now, I know I'm pivoting a little bit from commercial real estate into the housing market, but I suspect most of you are more interested in the housing market, not the commercial market. But we must know both to understand what's likely to happen in the future. Nonetheless, during the financial crisis, there were 18 million distressed sales, meaning the pain of recession, the pain of equity loss, the financial pain that the consumer was feeling was sufficient enough for them to sell their home at a massive discount because they had to. So there were foreclosures, there were short sales, and that was to the tune of 18 million, which is a big number, no doubt. However, the market itself, there were 140 million units sold, which means 122 million properties were not distressed. Well, what does that tell you? It tells you only 10 to 15% of the market needs to be distressed to see a 30% crash. And right now, there are almost no foreclosures. There are almost no short sales. But as the pain of recession increases, as the consumer feels more pain, that will be likely to change. And when it does, it only takes 10 to 15% of the market to bring down everything. Now, I don't say that to scare you. I say it to prepare you because each market will trade differently. There are different buyers in every market, and not every market is going to trade the same way. But make no mistake, when there's 10 to 15% of the overall sales that exist in the country which are in distress, it is going to bring down the value of all homes for sale. It's bound to happen, period. And yes, I've made the argument that some areas are going to be more insulated than others. But as they say, a rising tide brings up all boats, and a waning tide brings them all down. And right now, we are all ships in the sea, my friend. But let's get back to what's happening right now in terms of this commercial mortgage backed security market. The two properties in default are part of a portfolio called Brookfield DTLA Fund Office Trust Investor. The two properties in default, part of the portfolio, are the gas company tower, which has about 465 million in loans, and the 777 tower, lucky number 7, with about 290 million in debt, according to the filing. The fund manager has warned in November that it may face foreclosure on these properties. The company had the option to extend the maturity on the loans tied to the gas company tower, but elected not to, according to its latest filing. Now, it also elected not to get interest rate protection that was required for the loans for the 777 tower property, which amounts to a default event. We believe DTLA's decision to default on these two assets increases the risk for the remaining loans in their portfolio. Barclays PLC research analyst wrote in a note on Tuesday. Brookfield declined to comment. The values of comparable office buildings have broadly dropped, according to analysts. Office vacancies have increased across the country since the pandemic made working remotely more routine. The vacancy rate, and this is what you really need to pay attention to, vacancy rate was 22.7%, almost 23%. No bueno. The portfolio has a total of 2.28 billion in secured debt, according to a November filing. And other buildings with maturing debt, which include the Wells Fargo Center North Tower with 500 million in debt due in October, and Wells Fargo Center South Tower with 263 million maturing in November. The buildings have about 1.8 billion of floating rate obligations. Almost 2 billion. No bueno. That's a big number. And they're generally hedged with interest rate derivatives, which can translate to increased payments as the Federal Reserve raises interest rates. Well, if you've been paying attention, you see that in spite of all of their best efforts, inflation continues to go higher. And the Fed, which has been cutting rates, is now aggressively getting more hawkish. And so you can expect that they will raise interest rates, which will squeeze these commercial loans in a big way. And that will create more defaults. The lender has not foreclosed on the two properties or exercised other remedies available to them, according to the Brookfield filing. Now, in January, Oak Tree Capital Management wrestled control of the building, known for providing the exterior shots in the television series LA Law, after the owner, Core Trust Capital Partners, went into default on a loan tied to the property. No bueno. So now I suspect they took advantage of that weakness and got themselves a great deal. But the truth of the matter is, if we're seeing corporate defaults on major portfolios because interest rates are squeezing them and raising their interest rate payments, it's only a matter of time until that trickles down to the consumer, to the individual homeowner. Now, this article was published on Tuesday. Yesterday, I found another article which really got my attention. Now, the title of this article confirms what we already know in the last one, which is that malls are in trouble again and offices are next. And it says that the big real estate short is spreading to offices from shopping malls. And the commercial real estate short is spreading. And it goes on to say that in New Jersey, lenders to the American Dream Mall are heading to court demanding almost a $400 million payment on their defaulted debt. Now, anybody who's been to a mall recently knows that they have been completely cannibalized by Amazon, and the collapse of the US mall industry, which has long been hyped by Carl Icahn and other doomsayers, may indeed finally be near. The industry's been shaky for years, but now that interest rates are aggressively soaring from record low levels, lenders are beginning to move aggressively against property owners. Well, that's what is going to happen eventually to homeowners that are on the cusp of foreclosure. And to put that into perspective, if someone was to be foreclosed on today, it will take them a year or two before they're actually evicted from the house. So the pain of recession in the housing market is not likely to be felt for some time, which means if you're looking to time the market and get a bargain basement fire sale price, it's likely going to happen in the next 2 to 5 years. Unless, of course, some other thing happens, unless some type of other black swan event happens, I think that's the more realistic timeline. And to be totally clear, this is going to be a market by market basis. There are some areas that I suspect will be more insulated, but at the end of the day, the pain of recession will likely cause that 10 to 15% that we talked about earlier to bring down values everywhere. And to be clear, if your home was to take a massive hit in equity, if you bought $1 million home and your neighbor sold for 500,000, there's no incurred loss unless you sell, which is why it's critical to understand what your timeline in that house is. So to the best of your ability, you know that you can weather the storm, because in the interim, interest rates will continue to escalate. And it goes on to say that all of this marks the start of what's expected to be a wave of defaults in the wider commercial real estate industry, as that jump in borrowing cost causes property values to fall. Well, if this is happening in the commercial space, I can assure you it's only a matter of time until it hits residential. And short sellers are taking advantage of this weakness. They're beginning to circle once again. And in the event you're not familiar with what a short is, it really just means that an investor is betting that that sector or that instrument or that security is going down. And Brookfield, which I talked about earlier, has handed back the keys to some office properties, or they're opting to default, which is no bueno. Now, I did a video back in November talking about the liquidity crisis that is bound to destroy the housing market, which you can watch at the end of this video. But I've been talking about this for a long time. And over time, this absolutely has to happen. Now, I hope you found this content valuable. And if you did, please subscribe to the channel, give it a thumbs up, share it with a friend. If there's ever anything I can do to help serve or support you at the highest level, please reach out and check out my next video, because I suspect you will love it a lot. And until next time,